One of the hardest parts about investing is picking the right stocks, and if you plan to be in the market for a long period of time, you're gonna make some bad moves that will probably cost you some money. It's just inevitable. No investor has a 100% win rate, and everybody makes mistakes. It just comes with the territory, but hopefully this video will help you avoid making some of those mistakes, because we are gonna be talking about 3 dividend stocks you will always regret buying. So I think the best place to start when researching any new company is by asking yourself this very important question. Do you actually understand it? Putting money into something you can't wrap your head around is a recipe for disaster, and honestly is a lesson I've had to learn the hard way quite a few times. I've invested in companies that were totally beyond me, like CRISPR Therapeutics or Beyond Meat back in the day, and in some instances really only due to good luck, I somehow managed to make it out alive. Ironically, CRISPR actually ended up being one of my best trades. I had it at an average cost of about $46 per share and ended up selling it very near the top at $186 per share, so I locked in a nice gain with that one. But it could have just as easily gone the complete other way, and in fact, after I sold out of it, it did. And over the last couple of years, the share price has plummeted from a high of about $200 per share to now about $60 per share. I had no idea what I was doing with that company. I had no idea why I bought it. I had no clue why I sold it, and although it worked out, it scared the heck out of me, and truth be told, what I did with CRISPR Therapeutics was not investing. That was straight gambling. It was no better than putting money down on red and just praying for the best, and as an investor, you shouldn't ever put yourself in that situation. And the best way to avoid this is by investing in companies you actually understand, and by always staying within your circle of competence, as Warren and Charlie would say. And it's not just about knowing the numbers, although that is very important. It's also about knowing and understanding the qualitative aspects of these companies. Ask yourself, do you genuinely understand how the company makes money? Do you understand what makes them different, for better or for worse, from their competitors? And based on that, do you feel confident about their long-term potential? If you can feel good about the answers to those sort of questions, then great, that's a fantastic first step. But if you find that the company is just too over your head, then it probably belongs in your too hard pile, which is another helpful idea taken from Warren and Charlie. A good litmus test for this is to pretend like you are trying to explain the business to a 9-year-old. In a few sentences, try your best to explain the business in a way that is so simple a 9-year-old could understand it. If you can do that, then you're on the right track. But if not, then you may need to spend some more time with it. So this next type of stock is one that probably doesn't get talked about as often as it should, and I'm guilty of that as well. I think this actually is the first time that I'm talking about value traps here on the channel. Now, in case you've never heard this term before, a value trap is a stock that looks undervalued based on certain metrics like the PE ratio, the price to book, or the price to cash flow. And if you're out there searching for undervalued stocks to buy, in general, I think your head's in the right place. But when it comes to these value traps, although they may seem like a bargain on the surface, the term trap comes into play when this low valuation comes as a result of some deeper underlying problems that could be detrimental to the business. And there's some pretty clear signs to determine whether or not you're looking at a value trap. Probably the best indicator is the financials. If the business is facing fundamental issues such as declining sales or weakening margins, then the stock has a low valuation for a good reason. It's going to be hard to make money with a company like this, and there are definitely better places you can invest. Now, I may end up being wrong on this, but I think Walgreens Boots Alliance is a good example of a stock that looks like a value trap. It has all the makings. I mean, the company is looking very cheap. I mean, it's down 33% year to date, and if we zoom out over the last 5 years, it's down a whopping 67%. And the valuation metrics are all looking extremely attractive. I mean, starting here with the PE ratio, it's 7.5, so nice and low in the single digits. And also, if we look at the price to book, it's actually trading below its book value, with the price to book at 0.87, which is a whopping 42.7% below the 5-year average. So definitely cheaper than usual, and the forward price to cash flows much the same, looking low at 5.6, and this is 19.4% below the company's 5-year average. So on the surface, you might look at all of that and think, wow, Walgreens is looking pretty discounted right now. And if we look at the financials, this company's even growing their sales over the years, not by much, but still growing in revenue. That's a pretty sweet deal. But here's the kicker, and here's where things start to not look so great for Walgreens. Back over here on the income income statement, this company is becoming less profitable over time. We can see that their gross profit margin goes from about 28% 10 years ago, or in the mid-20s if we look here, all the way down to now being under 20%. If we scroll down a little bit, we're seeing a similar trend here on the operating income, going from a 5% operating margin down to a measly 1.6%. And we can see just in absolute terms, the operating income's going down over the years as well. Scrolling down even more and looking at the net income margin, this has been declining as well. It's had its ups and downs, but it's declining overall to the point where it's actually negative. Furthermore, if we jump over and take a look at the balance sheet on a net basis, Walgreens' debt has more than doubled just in the last few years, going from $15.8 billion in 2019 to now $33.7 billion as of their last report. And this has happened while at the same time they've seen a decrease in free cash flow per share, which is especially bad considering they've been buying back shares in recent years. So with all of that said, it's no surprise that Walgreens is trading at such a low valuation. And from my point of view, this company is looking like a value trap. And it might also be this next type of stock we're talking about. If it sounds too good to be true, it probably is, and that's something you should always keep in mind when you're looking at stocks or ETFs with ridiculously high dividend yields. Now, I'm not saying that you should stay away from high yield stocks completely, because there are some good ones out there, but at the same time, there are some really bad ones, and we refer to those as yield traps. These can be pretty easy to spot because they typically have a terrible track record of being able to sustain their dividend payments and ultimately end up having to reduce the payments over time, like in the case of Orchid Island Capital here, or sometimes they'll eliminate the dividend altogether, like what happened with Zim. Now, I understand how tempting a high dividend yield can be. It's easy to look at something like that and just think the more the merrier, but that's not how it works. You're gonna have to fight against the temptation to buy into that way of thinking. Instead, keep in mind that too much of a good thing can actually be bad. It's like drinking margaritas. I love a good margarita. It's my favorite cocktail, but too many of those and you might find yourself in some trouble. And it's the same thing with dividend yields. You don't want to end up with a yield trap. And with that, I've actually got 5 more stocks in this next video right over here that fall into that same category. And these are ones that you should never buy again. I would definitely consider all 5 of these to be big fat yield traps, and you should avoid them at all costs. So click right over here to find out why, and I'll see you in the next one.